Welcome back to the Tradeciety Traders Improve podcast. After a long pause, the podcasts are finally back, and I'm really happy to get back into the regular podcast routine, so you can expect roughly a podcast every week. And today I want to talk about overtrading. Specifically, I recently asked my YouTube audience, what should I talk about? What are their struggles? What are they currently dealing with in their trading? And then one trader said that he wants to trade all the time. What should he do? So we're talking about overtrading, and I have around 10 tips for you that you can apply to your own trading right away. They're super practical. It's not only theory, so you can use those tips in your trading immediately. First, I think the most obvious one is to have a trading plan. And what I do in my trading is that on the weekend, I sit down for 2 to 3 hours. I go through all of my markets. I mark up my charts. I update my levels. I look for potential movers for the next week. I see where there are the most interesting ones. And then I set price alerts, I write down and I flag them in TradingView so that I have a list of potential candidates and I know exactly what I want to look for on a specific market. And that helps me to stay organized. I also don't miss as many trades, and you know exactly what to look for and what you expect from a market. So having a trading plan is really beneficial in that regard, and that's why it's point number one. Another thing that can help is that you have limits in your trading. For example, how many trades are you willing to take per day and per week? And this is especially helpful if you have done a backtest or if you have a good, solid historical record of how many trading opportunities per week you can generally expect. If you see on average you can expect 5 trades per week, but suddenly you find yourself taking the 10th trade, something went wrong here. And that can also help you just to understand how long is the period between your trades. Do you have trades every single day, or are there periods where there are no trades for maybe a day, maybe 2, maybe 3 days? And that can also help you with this overtrading, because overtrading often comes from the need to trade. Traders don't know exactly how many trades they expect and they always want to be in the market. But once you have a good understanding of your trading system and you know how many setups and trades it will generate roughly, that can help you as well put your mind at ease. Next, point number 3, we talk about trading journals. And obviously, since we created Edgewonk, we have to talk about trading journals here as well, because it is such a helpful tool when it comes to overtrading as well. So in a trading journal, you record your past trades, and then when you go and analyze your past trades, you will see certain patterns in your trading. You will be able to find out the exact reasons behind a trade, what separates a good trade from a bad trade. And then over time, you can build also a checklist that will help you to understand when you look at a chart or a potential trade to see and compare, does this potential trade, does it show all the rules and the criteria that the good trades in my trading journal have? And once you're able to do that and to really verify what does a good trade look like and what are the signals that are present, then you will be able to also trade less on those trades where you know you shouldn't be trading. A trading journal is also quite helpful because it shows you the patterns in your tradings. Very often traders see specific emotional responses to trades. For example, you see that after a loss, you completely lose it, and that's where the overtrading happened. That is then a reminder for you to see, okay, I have taken a loss. I need to step back a little bit. I need to calm myself down to make sure that I don't enter the same pattern again. So a trading journal helps you as well with the mental aspect of the trading when it uncovers your emotional responses, the triggers, and then it shows you exactly how much are you losing under certain conditions. And once you see that, this is more likely to also transition into a change in your real trading. But those insights then will leak into your real trading. And that's where the power of the trading journal really shines, when you realize that it also impacts your actual trading decisions because of the insights that you have gathered about your trading behavior. One of the very important things, not only when it comes to overtrading, but in general, is that you have good risk management strategies. So that means you have a stop loss for every trade, a logical stop loss, and also that you have a position size. How many percentage per trade are you willing to risk on a given trade? And when you find yourself overtrading, very often traders also get very impulsive and emotional when it comes to position sizing. Maybe you had a losing trade, then you want to catch up on that loss, and then you double your position size, you increase it. Maybe you'd even take off your stop loss when you don't want to realize a potential losing trade and you hope that the market will just turn around. And having very solid position sizing and risk management rules can help you avoid some of the dangers that come with letting your risk management unchecked. Next, you need to have a good routine, and having a routine will really help you in your trading processes. It will bring a lot of consistency, and consistency in the end will help you in so many areas in your trading. So what I do is that I have a daily routine, I have a weekend routine, I have a scanning routine, I have a journaling routine. So I know exactly on what day and when, at what time I need to do a certain task or for my trading. A lot of traders, when they're overtrading, they feel bored, they feel they have nothing to do, and then they're just staring at charts all day long. But when you know exactly when is your active trading time, maybe you're just trading the London or the New York Open, and that's where you find the best trades, then sitting in front of your charts outside of your best performing trading hours is a recipe for disaster, because you are hunting trades when there are no trades or when you don't have an edge with your system. So having a clear routine and knowing exactly when to trade and what to do will help you as well with that. Next, focus on quality over quantity. A lot of traders obviously want to trade all to the time, and a lot of amateur traders especially have problems sitting out and not doing anything. But when you look at your trade quality, you will see this direct connection between the quality of your trades and the results. And the better the quality of your trades, when all of your signals align, typically the better the results will be as well. So making sure that you have this idea in mind, that you focus on the quality, you only want to take the absolute best trades possible. And of course, this means then trading less and only focusing on the highest probability systems. I mentioned it in the past, but having a checklist with all of your trading rules, with the criteria, and maybe even printing out 2 or 3 of the best trades that you have taken, where all of the setups and all of the rules align, that can also help you in your trade assessment and help you evaluate, is this really a good trade that you should be in right now? Another very helpful tip is that you have a stop and a loss limit. And that's very helpful because a lot of traders get easily emotional when they take 1 or 2 or 3 losses in a day. All the good intentions go out the window and this gambling mindset takes over, where they're trading recklessly. But if you have a stop loss limit or a daily loss limit where you say, okay, after 2 losses in a row and 2 losses in a day, I'm going to take the day off, I'm going to walk away no matter what. And that has a lot of benefits. First of all, you cannot cause more damage to your trading account. And then over time, you will also learn that it's not a big problem if you don't make back the losses right away. There's another day, there will be more trades. And especially beginning, it's so important to focus on risk mitigation. You want to control the downside. You want to limit your downside risk. And that is really helpful here as well. Next, you can use technology for price alerts. I've been using TradingView religiously for probably the last decade, and I am making use of the TradingView alert function a lot. Every day I set my alerts depending on important price levels. I want to get notified when the market crosses a specific barrier, support resistance, a moving average, when there's a pullback, when there's a move back into a round number. And I set those price alerts strategically at very important levels that make sense for the way I trade. And if a price alert doesn't go off, I know that there's no need to look at the chart. So I can do something else and I don't need to be glued to my screen all day long. And what you will see is that the more you look at your charts without a purpose, maybe you just randomly flip through your charts, you hunt for signals, that's a recipe for disaster, because then you end up forcing trades. But if you only look at the charts when there's really something to do, when the price alert goes off based on a predefined situation and a scenario, that's very helpful when you are able to reduce the screen time and only look at charts when it really makes sense and when it requires your attention. Engaging in other activities and getting your mind off of trading is also very important. Again, I come back to this, but the more you look at charts, the more there's the likelihood for you to make a mistake, to overtrade, to break your trading rules. So what I do, for example, is I always have the chess.com app open on my screen, and when there's nothing to do, instead of looking at charts, I will just play a round of chess. And that will get my mind completely off trading. I'm not going to open any random trades, and I can also do something relatively productively. You can obviously use that time in any way that you think it's valuable to you. For example, you could do backtesting, you can update your trading journal, you could read a book, whatever it is. Make sure that you have other things going on that take your mind off of trading, and that will help you as well. Again, remove the impulses and remove the ability for you to even get into a trade. It's also very important to understand the market conditions. When is your trading strategy working best, and what is the current market state? And then you can see, does your trading strategy currently have an edge? Is your trading strategy generating signals? For example, when the market isn't doing anything, the market is in a tight range and the market is range bound, doing nothing, moving sideways without momentum, then trend following and momentum traders will have a hard time and should stay out. So understanding in what market situations your trading system is performing best, and then looking at your chart to see, is this market situation, is this state currently favoring my system or not, will help you also to understand when you should look for trades and when you don't expect any trades. And then finally, also use different time frames. So I'm a big advocate of using multi-time frame analysis. And by zooming out, you will often see the bigger picture and it will help you understand the trade idea that you're currently looking at differently. Often what I see is that when traders are locked into their lower time frame, they miss the big picture and then they will overlook things. They maybe overlook a big support and resistance area. They overlook the trend direction, the market situation, the momentum structure, the volatility. And then on the lower time frame, it might all look quite good when you just look at this really tiny snapshot. But when you look at the broad picture, you will often understand that this is actually not a trade that I should take. So zooming out every now and then, and I personally always start my analysis on the higher time frame, will also help you understand the trade idea that you're looking at in the bigger picture. And then you can assess, is this a trade that you should be trading or are you forcing a trade right now? So I hope this helps. I hope there's some takeaway from you. Let me know in the YouTube comments, if you're watching this in the YouTube comments, what I should talk next about. Thank you for your attention and until the next time.